Marriage is about love. Divorce is about money. Without the right guidance, critical mistakes can have lasting financial consequences. That is where I come in. My name is Gabriela Martinelli, founder at Ever After Wealth. As a certified divorce financial analyst, I provide my clients financial clarity, strategic divorce planning, and long-term stability. On this podcast, I am sharing what you need to know about getting through a divorce, protecting your legacy, growing your wealth and assets post-divorce, and figuring it out what you really want in this next stage of life. Let's get started. Hi, Matt. Thank you for joining us today at the Divorce and Money podcast. I'm really looking forward to our conversation. But before we start, why don't you share with us a little bit of what do you do, a little bit about your firm, and then we'll jump into the actual juicy questions.
Sounds great. Well, appreciate you having me. So my name is Matt Springer. I'm a business valuation expert. I have over 20 years of experience, primarily providing valuations for litigation support, divorces, probate reasons, but also estate and gift tax and M&A purposes as well. My firm is VisionPoint Capital. They've been around for 10 years, and we're basically a little investment bank that can do everything with a focus and specialty in valuation. We also specialize in ESOPs and M&A work, and so can bring a transaction from cradle to grave. And the lit support is where I head up, and I'm happy to be here and discuss more about it today.
Awesome. Yeah. And, it's interesting. Most of my clients are business owners and physicians, which they are business owners because they own their practices most of the time. And I always say that divorce is one of the biggest M&A transaction for a business owner in their lives, because it's literally like an M&A transaction. So that's interesting. So tell us a little bit about a business valuation. What exactly is a business valuations for those that they don't really grasp because it means you're valuing your business, but how can we explain that a little bit for those that are listening that are not quite sure? And also, why is a business valuation so important during the divorce process from your point of view?
So I'll tag them together. So in the divorce process, right, an investment in a privately held entity can be one of the more complex tasks of the divorce itself. I mean, excluding kiddos, you put that in there and it can be a real tug of war with the spouses in terms of what's the value worth. And so by getting a qualified business appraisal prepared, you're basically hiring somebody that has the expertise, that has done the training, the educational requirements to get an accreditation. And there's several. It's an alphabet soup, but there's three primary, and those are the ASA, the American Society of Appraisers, the ABV, the Accredited Business Valuation, and then the CVA, the Certified Valuation Analysts. And so what those credentials will speak to is an individual that has the appropriate training that can produce credible, understandable, logical results and narrate and storytell them in a way that's convincing and ultimately can help the trier of fact, the mediator, the attorneys decide what the value of the business is. And so each credential has its own set of requirements for how to prepare an appraisal, and the appraiser is required to follow those credentials so that the person using the appraisal recognize that it's credible, trustworthy, and qualified to be able to opine on the matter of hand of valuing a privately held interest. That was a mouthful, but it's effectively giving the answer of what is the value of this business. And it's doing so in a way that's digestible, and it should be understandable to all parties involved that are relying on that appraisal.
Right. Now, there is different approaches, right? There's different ways to approach the valuation of a business, correct? So is there a particular reason why you use one approach other the other? You always use the three of them. Can you walk us through very, very shortly what the difference are with those approaches? And where do you start? How do you even start when somebody calls you and say, hey, Matt, I have a client is going through a divorce when you're going to need to value their business. So how do you start that conversation? And what information do you need initially from a business owner so you can start this process?
Yeah, so I mean, the first conversation is usually educational for both parties, myself and either the attorney or the client. And we're basically just performing a scoping call of trying to understand what the business is, what assets does it own? Importantly, does it own the real estate
Hmm.
that it's operating out of? Are there unique assets that are unusual? You know, are there Bitcoin, right, that need to be valued? And we just walk through the balance sheet, what's on the balance sheet, so that I have an idea of, okay, these are the assets that are in play. Now let's talk about how are those assets generating cash flows. And so we'll talk through, the profit and loss statement where we'll say, what sort of sales are they doing? Are they profitable? Are they taking an owner's salary? And I'm asking all these questions because I'm trying to narrow in exactly your question. How am I going to value this particular entity? And so I want to know is the income approach, which is basically we'll look at historical cash flows, project them out, and discount them at a rate that's commensurate with the discount level in those projections to a present value, subtract debt, and you get to an equity value. Is that income approach value, is that going to be greater than what's on the balance sheet? Are those assets being put to work? And if they're being put to work, are they generating cash flows that make it more valuable than if I just went and sold the assets? And so at the very beginning of the engagement, I'm scoping, is the income approach appropriate? The first method to value. Is the asset approach appropriate? Another method to value. And the last method to value would be a market approach. We would just go out and try to find transactions, whether they're public or private, for similar companies or similar assets. And then we would make, qualitative and quantitative comparisons to be able to determine a reasonable multiple to apply to a benefit stream. And then with those three valuation approaches, it's up to the appraiser to reconcile them, make sense of them, and communicate them in a way that's, reasonable, and credible. So those are the three methods. And in terms of
Okay.
information that I would be requesting, we
Mhm.
typically send over a full information list. It's comprehensive and it's not meant to scare the clients, right? But these are all things that we have to ask about as part of the divorce process
Right.
to make sure that it's
Right.
appropriately valued. But high level, it's usually 5 years of financials, 5 years of tax returns. Do you have projections available? And then if it's, a company where there's multiple shareholders, I'm definitely want to look to the operating agreements, the shareholder agreement to see what sort of rights and restrictions there are, because we have to get down to an individual that may not have control over the actual entity itself.
Right.
And discounts for lack of
Right.
control and marketability may apply. So multi-step process, but getting that financial information and that operating agreement really arms me with quite a bit of information that I can begin progressing and developing evaluation while we're waiting on other info.
That is great. And how important it is for you to talk to the business owner. And I know we talked about this when we had our previous conversation. And we deal with attorneys that sometimes like to keep a lot of control basically in the during the process. And but I always feel like it's very important for a business valuator to talk to my clients. I have had cases where I work where my clients does not talk to the business valuator when the other side hires a business valuator. So how important it is for you to talk to the business owner. I feel like there's a lot of things about a business that you can learn from the business owner that may not necessarily reflect on the paperwork. That it will be important for a business valuator to understand the business. So then you can go in and use your judgment when you get these calculations. But you need to understand not every business is the same. We can be the same industry, we can be kind of the same size, but in reality, each business operates differently, right? So how important is for you as a business evaluator to talk to this business owner, and what happens when you cannot? What are the risks there if you don't talk to them?
Sure. No, it's, I think, one of the more important aspects of the engagement. And in divorce settings, when they're not collaborative and the parties, aren't getting along wonderfully, you may not be able to get to talk to it. And I think that illuminates really when there's issues with evaluation is when an appraiser has to make assumptions because he didn't get that conversation. He doesn't understand that, the money that the children have been taking out of the business, out of, a safe in the office is filled with IOUs instead of actual paper money, right? Then that becomes a critical
Right.
concern and weakness in the valuation. So it's incredibly important, but I would also say that it's incredibly important to have a balanced, consideration when you're talking to management. Maybe there's a spouse that's not in the business itself, and that conversation can be just as illuminating, even though she's not in the business, or that they can tell
Oh
me how
yeah.
many hours are they actually taking a vacation, right? When they're on vacation, how heavily are they working? Those qualitative, observations that they can provide me insight to what a true workday experience is for this individual. How committed are they? Is the bank a personal piggy bank? At the end of the day, I don't care if the piggy bank is shattered and broken and needs to be glued back together. All I care about is counting the money that's in the piggy bank or the absence of money that might have been taken out of the piggy bank. So I'm following the paper trail, and that context that the owners can give me, or the non-spouse or the non-owner spouse can give me, are incredibly meaningful. And definitely, I try to pursue with every valuation that the attorneys will allow me to.
Yeah, which they should. I don't see the reason why evaluators should not talk to a business owner when it comes to that, because I think the business valuation most of the time is one of the biggest assets that we're going to divide, and we need to make sure that that number is accurate. So, and talking a little bit, you just mentioned something about vacation and how much they work on vacation. One of the biggest things that I always tell my clients, and I actually have an episode all about what you're supposed to do if you own a business, your books have to be clean. And as you know, that doesn't happen a lot. There's a lot of times where the books are clean, but a lot of the times the books are a little messy. I think I mentioned this. I work with a business owner, and their business was it was a really big business. It was almost $11 million when the valuation came, but most of their personal expenses were run through this business, which, oh my God, it was a nightmare.
Mhm.
From my point of view, it was a nightmare for the evaluator. But in reality, is this okay? I almost feel like, and I always say this, if you don't fix your book, somebody else is going to come and try to guess what is personal, what is not. And then they're going to come out with a business for your, a value for your business that it may not be accurate, because then you have someone like you having to guess, okay, are all these dinners work dinners? Are the COIs? Is this because of a big project? Or is this just the family dinners for their birthdays or their vacations? Are we traveling for work? Are we traveling just for vacation? Right. And I feel like that is one of the biggest one. And for me, is basic. Like, how are your books looking when you're going to go through this process? Because it can create a big difference. And then, and I'm going to let you answer, but I'm going to go a little step forward. A lot of the times it creates this false uh, idea that the business is running so well and they have so much money and they're having this big lifestyle, but it's the business literally just paying for everything, when in reality it should be separated, right? And I'm not even going to talk about taxes or any of that, because in reality that doesn't matter when I'm working with someone during a divorce. But it also creates this false narrative that, oh, we have this money, we've been going on all of these trips and we're going on vacation and we buy the cars, but in reality, this is just a result of really bad administration, if you will, from a financial point of view, where you should literally separate your personal expenses from your business expenses, have owners withdraw W-2 income, whatever you want to call it, but based your lifestyle within your income, not the business, just kind of like being the one that takes care of all your personal lifestyle. I feel it creates a lot of problems, not just on the business valuation, but on the lifestyle analysis when we're talking about support, basically, for the other
Right.
spouse, right?
Yeah, and I mean, you're hitting on multifaceted issues that regularly come up, and there's not an answer that solves all problem, right? Every divorce is, well, it depends. But in this
Yes.
case, I mean, if what you're looking at is, you know, cash that has been used improperly and it's not been, identified, tagged, and put into the appropriate categorizations, then you're unfortunately leaving it up to an expert to have to make that decision in terms of how to classify it. And the expert can get it right if they have those open conversations and they have access to management and the other side's being
Yeah.
honest and not trying to hide the baby. If we can have those open conversations, we can lead to a conclusion, right, that's supported by evidence because management's guided me there. In instances in which management isn't guiding you there, all we have that we can look at is comparable companies, comparable transactions, what in a normal operating setting where, the companies run to benefit the shareholders in the long run, what are the normal, operating expenses, whether that's an advertising budget, and meals and entertainment, and we can start to categorize those as a percentage of sales. And so the more data points that we can look to, we can then begin to build some assumptions about like what's reasonable. And then it's slowly
Right.
going through each every year and trying to identify things that look like they're outside the normal bounds of what's reasonable. Going through all of the bank activity and looking at every transaction, trying to identify transactions that look suspicious. Maybe they're rounded dollars, large amounts, one-time events.
Right.
Really getting into the granular detail so that if you're making an add back to a benefit stream, if it's a non-recurring or a personal expense, that there's evidence that supports why you're doing that. And I think that that goes back to the very beginning of our conversation with like, what is an appraisal and what does it produce? And I kind of ran down through these lists. You're basically
Yeah.
developing this logical approach to how you're going to make these adjustments so that it's defensible and it's understandable to the audience. Because the judge, the mediator, the attorneys, I mean, you're basically educating different layers of people and specialists that are involved in the divorce process. And so while you may not get the clearest answer, what should all add backs be, you can certainly make some pretty significant concrete assumptions about what should we adjust for and why are we adjusting for it, and how does that look from year to year.
I love that you said that. And I want to go back about your audience because I think that is very important to understand that anytime that you do that type of analysis, you do a business valuation, I do lifestyle analysis, expenses analysis, et cetera, et cetera, et cetera for my clients. You always have to think who are you going to present this to? It's not just the client that I'm working with, so they understand why an asset is valued in a certain way or why it can or cannot be divided, et cetera. There's the judge. You're going to have to basically put your case on and the judge will need to understand this so they will believe you basically because right when you testify in court is either whether the judge believes you or the other expert if you have two experts. So I like that, but I want to talk a little bit about because it's a little bit of an elephant in the room, I feel. And I know we touched this a little bit because when you just say you're making assumptions, right? You don't know these people, you don't know this business. Like you know businesses, you know, you because you have the credentials and you've been doing this for a long time. But that particular specific business, like you said, is one divorce, is one specific bubble where they stand. What happens when a evaluator is hired, let's say from the other side, is not the business owner? And because there's so many assumptions, how common is it that a business evaluator could potentially slant their work one way or another, or make the different assumptions depending on who hired them in this process? Whether it's a business owner, if there's one business owner and the other spouse is not attached to the business, and it's the other side that is actually the one doing the valuation. So how common is it? Do you see that? Is that something that happens? And I can tell you a little bit of a personal story with another client later, but I want your answer first about this. I
Sure.
think it's very
Yeah.
important.
I think that at the end of the day, you're getting hired, I'm getting hired based on our trustworthiness, right? And
Mm-hmm.
that goes back to the credentialing process. And,
Mm-hmm.
not all credentials are created equally. There are very extensive reporting requirements that the USPAP requires for the IRS, which is the Uniform Standards of Appraisal Practice. And it's basically just outlines like what your report has to include, what it should consider, how is it documented, how is it explained. These are all the factors that need to be hit on. And what I have found is that you'll find certain credentials that don't have to necessarily adhere to that because they don't have that credential. They get around, right, having to produce a report. And as a result of getting around, it may mislead the reader, whether that's intentional or unintentional, right? But because they didn't
Right.
have such stringent documentation requirements, that it's easier to get to a conclusion that maybe one side or the other might find more reasonable. And so then it comes back to the expert, right? After the credentials, it's the expert. And, one of the areas that I've been able to find success in my career is to work more in the collaborative divorce space where I'm working with both sides, whether that's a mediator or an arbitration. And I found that, there's just so much more success in those spaces. I think the statistic is like 75% of mediations are successful, something like 85 to 94% of collaborative divorces are successful. And so with such high success rates, getting somebody that's in there that's retained by both sides can eliminate, right, slanting it one way or the other. And the final thought, I'll close on is that, who the expert regularly works with matters, right? And they can get up and say that
Mm.
they're unbiased, but if they're asked on the stand, how many engagements have you performed for this law firm? I think that the question of credibility
Huh.
can be slipped in there as a result of you're regularly engaged, right? And do you have a history of, working with this attorney? And, if so, I think that there could be some suspicion as the reason they keep getting hired is because they keep giving them the result they want. And, while I love to get hired again, I'd much rather be hired on the fact that the work that I produced, they can truly believe that I think that it's middle of the fairway and I'm not pushing the envelope left or right. So it's a
Yeah.
multifaceted, question, and there's honest players, there's dishonest players. But I think that the appraisal practice in large, there's been so much certification and credentialing process that it's gotten significantly better than it was, say, in the 1970s. So always room
Yeah.
for improvement, and there's, the advisory boards are trying to make all of the appraisal practice more uniform. But at the end of the day, the expert matters. And so check the credentials,
Yeah.
check their history.
Yeah, that is so interesting that you said that, and I guess I never put it into words. That is, yeah, because it's it's very common, right? When I have somebody hires me in a specific jurisdiction, and we're talking to the attorney, we're talking about doing a business valuation, we talk about valuators, and this has come so often, and it just came to me when you said that because initially I always said, oh, well, that law firm, the one that is representing the other side, they usually hire this person. Like they always hire the one person. And it just hits me. That is a great question to ask. How many times have you worked for this particular attorney? Because it gets to that. And it's so interesting because I just had that thought. I'm like, wow, that happens. I say it. I say, well, they are going to hire X because they always work with that valuator particularly.
Mhm.
So that is very interesting that you said that, and I gotta tell you, I am not a business valuator. I have toyed with the idea of getting my certification, but not to do a business valuation actually, because I think it takes a lot of time. It will take away a lot from the work that I want to do. I'd rather much have someone that actually has all of the experience that can do that. Give me the number, and I can work helping my client to really find a way to make a resolution. But I will tell you, I have seen in really good firms that work with certain attorneys where I'm looking at their report and the reports make no sense. And I was particularly sitting in one, it was a dentist, and they did a practice valuation. And when I read it, it was so interesting to me. The comps that they used were on the other side of the country, like we literally were in the West Coast, and they used their comps with dental practices that were on the East Coast. And I thought, well, that makes no sense. Like the geographic location of a business has a lot to do with the
Sure.
business when you're going to value it. And it was so interesting to me because I'm like, these individuals are not, they know what they're doing. They are a big firm. They do this constantly, like maybe you do. And I thought, okay, what are we trying to do here? Because of course they came out with a number that wasn't the right number, and we had to do two more valuations anyway in the case. But at the same time, I was like, okay, you're using comps that are not. It's almost like having a house appraised based on the houses that are in some neighborhood in the other side of the country. It makes zero sense. And I thought, okay, is this because they're working with this particular client and they're trying to get some particular result? I don't know. It was brought up. We'll talk about that. It was brought up in a deposition. We were talking about the how fun depositions are, and that was the question. One of the questions that I listed for my client's attorney to ask. I mean, why would you using? I mean, it's not like they're dental practices, right? I understand some other businesses are rare, and you may not have a lot to compare within a region, but that seemed a little extreme to me. So anyway, I thought that was a thought that it came back to me. So I know you do you like to work with both spouses, do the one neutral, and I like it. And I know that I pushed back a little bit when we were talking about this, because I have a lot of times that when we decide to hire the one valuator and then somebody's not happy, And then they said, oh no, I'm going to go get mine. So there's more, expenses. Now it's a little caveat here, and I feel like it's almost a place where we could do a little bit more and cost less for the clients, more time effective. You have a credential that is an appraisal review credential, right? This is not a business valuation. You have the appraisal review credential, right?
That's
So
correct.
can you explain to me what that does that mean, and how would that help? For example, if I'm working with someone that is going through a mediation and we have one valuation and we say, okay, before we go and get another full on valuation, can we talk to someone and see if they can review it and give us a neutral assessment of this particular valuation? Is that part of what you could do?
Absolutely. No,
Okay.
that's good. Good understanding for a credential that there's not very many out there yet. There's only,
Yeah.
to my knowledge, I think 100 people in the United States that have that particular credential. And so,
Mm-hmm.
but effectively, to your point, it's yes. If, oftentimes control is such a big issue with, they want to manage the process and the timeline and, who's involved, who's
Yeah.
not involved. And, oh, if she's going to get or he's going to get an attorney or, an expert, I need my own. And I think that
Yeah.
better education, and it's sometimes difficult to disarm the attorneys who are litigious in nature, to let them know that, like, I'm happy to work with both of you and represent both of your interests independently. I'm not going to advocate
Right.
for your client, but I'm going to at least come with up with a valuation that I think is reasonable based on the facts of both sides. And so
Right.
when that doesn't happen and it does break down, there is an opportunity for an attorney, or if it's the client themselves that don't have an attorney yet, to reach out to somebody to ask them for a cursory review of the appraisal. And so what the appraisal review and management designation allows me to do is to take an appraisal and review it according to USPAP. The exact requirements of the review are laid out in USPAP. And then I can say, look, I agree with these parts of the appraisal, but I don't agree with this. I don't agree that they should have used these dental transactions in two different locations for these particular reasons. And if I were to adjust that methodology alone, the value would change like this. And as it flows through the analysis, the conclusion would be this. And if that's the only change that I think is required to be made, I can opine on that change. And so instead of me having to produce a full-blown appraisal that's, the exact same cost as the other appraiser did it, I can try to help mitigate costs and save money by looking to what do I agree with, what do I not agree with, and then put it into a USPAP compliant appraisal review report that says this is what I think is a reasonable value. And maybe it's changed slightly, and it's someone's unhappy, someone's a little bit happier. I mean, that's where we're trying to guide ultimately fair market value, typically, because it's between a hypothetical buyer and seller, and we want to be somewhere in the middle where negotiations have been ongoing and they land in a place that they finally feel is reasonable.
Yeah. And do you find, I'm assuming that it may be the hardest for you would be to talk to the spouse that is not the business owner, or they were not involved within the business, because, there's a lot of information and misinformation going around. And there's a lot of times where the individuals have this preconceived idea of how much a business is value, and maybe it goes back to the how we utilize the cash flow in the business, so it feels like our lifestyle is a little bit different than it could be if we were not using the money that way, or we structure the finances differently. So do you find sometimes the biggest challenge could be the spouse that is not involved in the business, for them to understand how you come up to a number that, again, it may be realistic, but not for them, or their preconceptions of what the business value it actually is. I feel like that is almost like you have to do a lot of more of education when
Yeah.
it comes to someone that is not involved in the numbers.
I think that you hit it, and I wouldn't say it's a challenge. I think it's an opportunity, right? That
Okay.
to get both parties to think that the conclusion is reasonable, I have to be able to educate the non-spouse as to why I think the business should be valued this way. And while at first they may be armed and they want to have serious conversations about why I think the value is this or that, I, I think at the end of those conversations, they see it from my perspective and they know that I'm not trying to go high or low because I will talk about like where the subjectivity is in terms of my assumptions. And if I had
Right.
additional information, these assumptions might change, but based on what I have and the facts that are laid out in front of me, this is the direction that I've gone. And so I think that, and you can just get so much valuable information from them. Even if they don't know the ins and outs, they know the players involved. Spouses usually talk
Right.
and where their risks in the business are, where the strengths are in the business. And so you get an individual that's in the business and they're like, oh, this year was terrible. And, the outlook's so grim. And it's like, there's going to be a balance act of I'm going to hear that. I hear that often in this line of business. And I need to look at the trends in the business and then do the research itself in the market, or is there an uptick? I got involved in a healthcare related litigation dispute, 3 months in, 4 months into COVID. And the
Oh,
outlook is grim, and it's like, what are we going to do? But there were markers at the time that where you could look into the actual market pricing and see that there's starting to be a little bit of a correction, even that far into COVID. So facts and circumstances
wow.
matter. You just need to make sure that you're able to hear the story that they're telling, the story that the finances are telling you, and then what the market's telling you as well. So lots of
Yeah.
research involved for sure, but again, I think it's an opportunity more than anything else.
Yeah, and I gotta tell you, because you mentioned that the business is not doing well, and it's just kind of interesting because it's like, okay, yes, you're dealing with a business owner. You're going to hear the business is not doing well this year if they're going through a divorce. I do sometimes push a little bit on that because especially in businesses that are more like a service business and is not a product business. Because in reality, if you have a person that is the person that runs the business, they may have employees and all that. Going through a divorce is going to affect your life. So I do believe that affects the business as well. Maybe not to the extremes that we hear, like, oh, well, the business is almost like zero value and we had to just let it go. But I do believe that is something that it should be taken into account. And maybe not for you as a business evaluator, but I do bring that a lot because when I have my business owners that are going through this process, it is affecting the day to day that they're dealing. Again, physicians, dentists, I mean, they have to go to work, they have to do what they do. And it is affecting potentially the business and how the business is running. That's not to say that, you look the last 5 years and we know that when this process is over, they're going to go back to their optimal performance. But I think like that has a lot to do also with the personal goodwill, right? When you are actually valuing the business, because in some businesses, personal goodwill will be a significant higher percentage of this value, if you will. And we also have the situation where different jurisdictions, different states, they look at personal goodwill very differently. I know we talked about Florida recently. Well, recently, it's been a couple of years. They changed the law. Now, personal goodwill is separate property. North Carolina still considers personal goodwill to be marital property. So it is important for us to understand the percentage that is actually given to a personal goodwill, but it will not really affect the division per se. Does that affect how you value these businesses, how the law looks at it, or you just are like, okay, I'm gonna just look at this business, this is my percentage, it has nothing to do with the law, and then I'm gonna let everyone else that knows how to accommodate this value per the law in the divorce realm, how they're gonna use that percentage.
The first thing is to alleviate your concerns about all these the impact that a divorce causes, right? So much trauma, perhaps it's
Yes.
midlife and other variables are going on in your personal lives. And so it's just so much stress and you're distracted. And it does take a hit
Yeah.
often on the business itself. And
Yeah.
so when you're valuing it, right, we have the opportunity to look backwards and forwards. And when we're looking backwards, we can normalize what will it be if things smooth out, right? If I'm the hypothetical buyer that's coming in here and I buy this business and I were to replace management and we got refocused on the business, how could I reasonably grow this going forward? And so that's the mindset, at least that I'm
Ah.
going through, is I'm not looking so much at the personal turmoil of this individual. I'm looking at if this business was purchased, how can it run and what do margins look like going forward in the future? And I'll throw in just two more thoughts there that if a company's
Yeah.
really upside down and personal expenses are going through everywhere, I mean, there are benefit streams that we can look to with the market approach where we can look to like an enterprise value to revenue multiple. And what that means is, what is the value of the business if we just look at the revenues only as a component of the total size of other similar businesses? And so we can develop what those revenue multiples are, and revenues are the top line. So there's no expenses running through that. So if I'm not able to talk to management and I can't identify any of those, what those add backs might be to say an EBITDA or a cash flow, I can certainly look at the top line and still make a conclusion on what I think the value of the business is. And I'll often frame that when I'm doing the initial consultation with both owners. It's like, it's garbage in, garbage out. If you don't give me great information, I can't produce credible results. I can only make assumptions and then opine on why my results are credible based on the fact I didn't have info. And so if you tell them, like,
Yeah.
if you don't speak to me, right, there's a disadvantage inherently to you because I now have to make an assumption that you may not agree with. And so it's just better if, like, let's have an open conversation. And I'll even ask the spouses and both parties, not on the same call, that, right, this isn't done at the same time, unless they agree to that.
Right.
It's that these are private one-on-one conversations, and it's conversations like, tell me what the other spouse doesn't want me to know, right? About the business, about something that's going to impact finances. And we ask the same question over here. And so you're getting a multifaceted response in terms of getting a clear picture to make those adjustments. The other adjustment
Right.
is similar. It's enterprise value to seller's discretionary earnings, and you're basically just saying, okay, if I add back the owner's comp and everything that I think is a personal expense along the way, now this is all of the cash flow for the business, and I can determine what the value is that way. And so I'll go find transactions and do that very technique. And so
Right.
that's me adding a whole bunch of stuff back. And so it's which direction do you want me to
Yeah.
go? Make no adjustments and go top line, or make a whole bunch of adjustments and I can go through the seller's discretionary earnings. So
Right.
with that being said, then you get to the question of, okay, I've got the value, right? How do I allocate what's intangible versus enterprise goodwill? And
Right.
there's approaches that are commonly used, and they may include the with and without. And it's basically you take an individual if they're running a practice. What happens if you remove that individual? Is there a non-compete that prohibits him from going across the street and setting up shop? Because if not, then he could effectively go set up shop somewhere else. He could close the operations down, and the value without
Mm.
would effectively be zero. And so
Right.
you can take a look at that methodology, but then you can take a look at, and I'm sure you've come across it, is the multi-attribute utility method. And it's just a mathematical
Yeah.
calculation of quantifying subjectivity. Like you think about all of the intangible assets of the enterprise, whether it's location, referrals, for are they coming to the company? Are they coming for the physician? Is how many stores are there? Are they conveniently located? Does the name have the last name of the owner on it? Those would inherently suggest that if they're all coming because it's Dr. Smith, right? Dr. Smith is the
Right.
reason they're coming. You're going to allocate more to
Yes.
intangible for personal goodwill. So
Yeah.
those are subjective, but the real goal is, can you balance those two methods together? Can you perform a with and without? And then can you do this goodwill allocation calculation and do the results seem reasonable? And so there are ways to get there. And then I would say just lastly, just like the market research comment that I had for you earlier, right? There's plenty of Supreme Court cases. There's plenty of appellate court
Yes.
decisions that you can go and you can read how did a judge decide that case. And you can often find
Yes.
instances where the exact same type of business, physician, everything is included in a court case, and you can follow that, or you can take
Yeah.
interpretations out of that. And, with the guidance of an attorney, make an argument as to why this is justified. Because at the end of the day, those
Yeah.
are legal arguments, and we're not hired to make those legal arguments. We're hired to determine what
Right.
the value is. So we have to make sure that the standard of value the attorney has guided us with, that's a legal consideration as well. And so
Yeah.
it's nuanced, but it's solvable. And I think that
Yes.
you touched on this earlier. Like, yes, we want to talk to the spouses, but I want to talk to the opposing expert too. Like, where we
Yeah.
can eliminate differences early on in the process, like let's have a conversation about that. And so,
Yeah.
I'll recommend to the attorneys that hire me. It's like, I would love to be able to speak with the opposing expert with no attorneys in the room. If you want to be in the room, great. But I found that, when we're disarmed and we don't have to, be so concerned about every single statement that we're making, that we can just have an open dialogue. And if we can get to a conclusion that's reasonable, like let's get there. Like what are we fighting for when it comes to subjectivity? So, but it all comes down to identification, documentation, and then being able to articulate your story. So as you get creative with your
Yeah.
lifestyle planning, it's like you have to be able to communicate the why. Why does this make sense? And it's the same
Right.
thing with the allocation issue.
Yeah. Wow, I love that you said that because to me is always ideal when we're going to mediation if I can talk to the other financial expert on the other side. Like, can we try to figure out what are we doing differently so we can meet in the middle and we can help these individuals rather than having the attorneys fighting for something they may not really quite understand. So I love that. I do think that each professional should talk because, again, numbers to me don't lie. And in your case, when you're doing a business valuation, there's a lot of interpretation, and it seems like there's a lot of leeway, or maybe not a lot, but there's some leeway on how you look at those numbers and look at the company, etc. And I feel like, yeah, talking to the other expert can help you figure out where are the differences, and maybe rather than sitting in a courtroom trying to convince a judge that your way is better than the other, let's talk to the professionals, see if we can come up with the number, right? Because my only beef is when we get two valuators and the numbers are up here and there, right? And I know that you used a golf analogy when we talked the first time, talking about, the fairway in golf when we are talking about the fair market value. And I
Mhm.
think that's when you get the difference, right? One goes one way, one goes the other way, uh, because you see it, right? So how is that sometimes you get two very well qualified experts and business evaluator to come up to numbers that are so far away from each other? And it's very hard, right? Because when somebody saw that report, somebody saw a lower number, if it's a business owner, they're going to stick to it, and the other side is going to be the opposite, and it's going to be very hard to get those people to come to a middle ground when you're so far away from each other between those two evaluators, right?
Certainly, yeah. I mean, I was involved in a divorce in which the husband was very wealthy from his business activities, and the attorney that was hired in brought in two more attorneys. So now we have three attorneys in that room, and then we
Hmm.
had the original expert. That expert and the opposing expert did not agree. So then they brought in an additional appraisal review, candidate like myself, and then even another expert valuation firm. And so on any given call, there's, close to 8 professionals that are sitting there that are all billing hourly, right, to
Yes.
do and deal with what you just described, that the other side was so high in terms of their value and the other side was so low in terms of their value, is how can we improve the appraisal that's been prepared so that we can come to a place that's more reasonable, because we're going to be fighting for a very long time trying to bridge this gap. And
Mhm.
in that particular case, what we all agreed to, all of the appraisers in the room agreed to effectively, was that the opposing expert got it wrong. And we needed to educate the attorneys on how to better attack the opposing expert's work. And so there are times in which it certainly does get more expensive, but there are times where it's warranted.
Yeah.
If you get bad work, right, you shouldn't accept bad work just to get to a conclusion
Yes.
that's reasonable. But
Yeah.
that said, another example is, I think we talked about it last time we spoke, was just, the podcast individual that was getting divorced,
Yes.
right? If it's
Hmm.
your show and you're going through a divorce process and we value the business and we'll just say it's $1 million, right? And you've got no real fixed assets other than your equipment, right? Maybe the space that you're leasing or maybe you own it, but the difference between whatever the book value of equity is that you would mark to market, whatever the difference between that and the value of the equity of the company after you do the income approach, market approach, that is effectively intangible assets. And so that's where we have to go back to the percentage allocation. Well, what's considered personal? What's
Yes.
considered enterprise? And so if it's your show with your name on it and you're the only one running it, like you're going to think that that's going to be really high. And in fact, it was really high in the divorce that I was involved in. Um, I think I originally shot out at 80% for the out spouse. Is like I valued the business. I think it's 80%. Opposing experts said it was closer to 90%. And as a result, we were off. But I mean, that's one of those extreme cases where personal goodwill allocation is subjective. But if you document it, identify it, I think that most people could come to an understanding that if it's your own show and you're the one generating all the wealth, that the significant portion of it is related to personal goodwill.
Yeah, that is a very, very tricky situation to be in because, like I mentioned, some jurisdictions consider that to be
Mhm.
still marital property. So you're literally going to have to potentially do a payment, or it has to be taken into consideration the full on value of this business, even though the value has within itself 85, 90% of your personal goodwill, meaning if you're not there tomorrow, the business is gone. However, the value is assigned for this division as if you were there forever, which I that is very hard for the individual that owns the business to understand because yes, it's you, like it's literally the person. It happens a lot with physicians and doctors, right? And you mentioned it's not just is their reputation, it's not just their work, right? And then we are assuming they're there the whole time, and it's marital. It's almost like you're dividing your own personal capabilities and your knowledge, right? And we don't want to get a lot into that, but I do have to have those hard conversations sometimes with my clients because of that. It's just the way it is because the way the law works. And again, the law is going to trump anything. You try to accommodate it or move it around and try to come out to a resolution that is good for everyone. But it's just the nature of the beast, if you will.
There are certainly like theoretical frameworks related to personal goodwill that the
Okay.
state hasn't ruled upon yet. And so when you get
Yes.
into the weeds and you really have to start looking to other examples and maybe other jurisdictions. And so it's not always, even though
Yes.
precedent may establish in Texas, where I'm located, if
Okay.
there's not sufficient case law on how to rule on something, sometimes you have to take examples from other cases and try to take those inner workings, what the judge was thinking in terms of their interpretation of the law, and apply it in a way
Yes.
because you don't have a better way to do it. So there are instances,
Yeah.
and then, but I think it comes back to that documentation, right? Identification, that if you're giving this information to a judge so that they can make a decision, have you adequately outlined what your thoughts are, right? This isn't just a qualitative sentence. I think that it's 80% for this two factors. It's a well thought out process that's gone through every single intangible asset that could exist, perhaps in the corporation, right? Trademarks, trade
Yeah.
names, and actually take that out of the equation so that what are we really trying to value here? Is it personal goodwill or is it some other corporate or enterprise intangible asset? And so documentation, 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 and being able to storytell and narrate why that documentation has led you to your conclusion is, I think, the best thing that you can do. So it's not just it's the way that it is, it's this is the best
I
facts that
love
I had
it.
available, and this is the way that I believe it is a reasonable conclusion that's been reached.
I love that you say that. And I'm going to put you a little bit on the spot. And you don't have to answer, and you can tell me if you don't. But I want to ask you this because this is particularly talking about personal goodwill. And as a business valuator, for let's talk about a particular, let's say you work with doctors, physicians, right? Like you, let's say you talk about them particularly. Do you have a position as far as personal goodwill when it comes to a particular industry that is your position, that you want to use it in your calculations? You're going to use that information and your personal understanding, and then you're going to go and look for the law and everything else that would actually help make your point as believable? Or do you change depending who you're working with within the same industry? And I'm going to tell you what I mean by this. There is a case actually pending in a state, and I don't want to get into a lot of details because I don't want to really people to be identified. But there's a case waiting for the Supreme Court in the state that it has to do with personal goodwill. And the interesting part to me is like the expert used by the party that is taking this all the way to the high level, right? To talk about personal goodwill. The evaluator they use, this expert, excellent expert, has been doing this for a very long time, has a position in this particular instance with a medical practice that the personal goodwill is separate property and it should not be part of the valuation for the division of the assets. Okay, the divorce. That was his position. That's where all of this is based, all through Court of Appeals, now Supreme Court, waiting on a opinion to come out. But the same expert testified in another case with the opposite belief when it came to personal goodwill in the very same set of circumstances and the same type of business, which I know that that's the question that was asked of him on the bench. Is like, you are arguing the exact same opposite in the same set of circumstances in this other case. Right. So is that a little bit about depending who you're working with, or how does evaluator positions themselves getting those? I mean, I have my own beliefs when it comes to my work, and I always work the same way, except different circumstances for my clients. But how does it work for evaluator with a business? Does that, yes, I mean, is that putting you in the spot? Is that too much of a question?
No. Okay. I mean, case law and precedent is what takes over, right? And then from there, because it's a legal question, the attorneys will interpret and communicate, this is how it should be approached. And so in terms of me valuing it, I'm now abiding by case law, the statutes, or an attorney providing a legal interpretation of something that this is how it should be. And that's all should be documented in the engagement letter. When you're scoping out the assignment, right, you want to say, look, I'm valuing it this way. This is the standard of value that I'm valuing it under. This is, potentially how I have to interpret, personal goodwill. And as a result, this is now the framework for my valuation. So if I was, and I'm not, but if I was providing guidance, let's say to another attorney in terms of what questions to ask an opposing expert that's gone on both sides, it's like the very first thing that I want to see is what your engagement letter said. Did you properly frame out this assignment? Because if you did, then there should be no question whether or not you flipped your answers. It should be a rational conclusion that's been reached because you've already told the audience what you're going to do on the forefront. And so the last thing I'll say is if along the way the attorney, right, so you engage it and you say, I'm going to allocate what personal goodwill is because that's what's required in this particular engagement. And along the way, the attorney changes their mind, right, and says, oh, now we don't want you to do it that way. This is how we now interpret it. All that I have to do as an appraiser is have an extraordinary assumption in there that says, I was originally engaged to do this. The attorney in case has, told me to augment my opinion so that I'm now considering personal good this way as a legal framework or a legal definition. And now this is my results. And again, all coming back to the very beginning of our conversation, you're just building consistency, reasonableness, you're being objective and you're disclosing everything so that what you get at the end result isn't a game of, I'm playing the game high-low, I was a hired gun. This is all documented and I'm not trying to hide anything from anybody. And so that sort of awareness that I think that maybe most appraisers don't have, that at least I haven't been in the litigation support, field, that it's just kind of going through the routines and it's really not in a legal setting. Like everything needs to be considered from communications to, how you frame your engagement letter so that when you do get to the end and you're sitting there and now you have a different perspective on personal goodwill that conflicts with something earlier that you've done in your career, you have an explanation as to why that's the case. And hopefully it's not just grasping for straws at that point, especially if you're on the stand.
I love it. Yes. And I think that is so important. And individuals going through this process don't know this. And this is why the experts that you hire are so important. 100%. Understanding how they're going to approach this. And even if you're going through mediation, you got to think that one day they may depose you, one day you may be on the stand. Right. So, Matt, this was a great conversation. I know we took a lot of time. There's so many other things that I would like questions for you to answer. But basically, what would you say to a business owner that is maybe considering or in the beginning of this process of the divorce, as a business owner and as a business evaluator that may need to look into everything about that business? What is the piece of advice you will give to a business owner today? That if anything, if they didn't hear anything else you said or we discussed, what is the one thing you want them to remember?
So it
during the
depends
process?
on who I'm speaking to, but let's say it's the business owner that has knowledge of
The
the
business
operation.
owner. Yeah.
To be candid with me, right? Let's not disclose what you think I should hear. Let's disclose what I need to know. And sometimes those are conversations that are difficult to have. But I have found that being direct, right? I am perfectly content asking, are there extramarital affairs that I need to be aware of? Are there expenses embedded in there? Let me know what I should know so that if I'm representing, if I'm the qualified expert for you and I get up on the stand and I'm asked about those expenses, I'm not sitting in a hot seat without an answer. Because my answer is going to be, I asked the question and the question was answered that they weren't in there. So no longer did I make the wrong answer, right? You just did not give me the information that I needed, that I did ask, and I can disclose that. So have those difficult conversations. But then, the financial information, and this is like not just for litigation support, but for all valuation
Yeah.
engagements. It's like the M&A process you were speaking about earlier. It can feel overwhelming at the forefront of
Yeah.
the engagement. And oh my gosh, they're asking for so much. And I'm dealing with the divorce. I'm dealing with the actual, running of the business. Get me the financials and the operating agreement and a budget if one's available as fast as you can, because that's going to accelerate my valuation modeling skills and or capabilities. And we're going to start developing the valuation model itself. Once we've got that model established, then we jump into the management interview, and then I'm asking for all those other parts of the information request. So give me the info quickly. Let me know what I don't, what you think I should not know, because it's helpful in
Yes.
speeding up the process.
Yeah. Oh, I love it. I think that is great. That is very important. Just be honest and tell us everything, even if you don't think we should know, because that's you don't want to be in the hot spot when you're on the seat and the other side is asking you those questions. Matt, how can anybody find you? Where will they find you? And we're going to put this in the notes, but just tell us, where can they find you?
Sure. So visionpointcapital.com is our website. My email address is matt.springer@visionpointcapital.com. And my mobile is 832-727-0336. So happy to have a conversation and see how it can be of assistance.
Awesome. Thank you so much, Matt. Thank you for joining us. And thank you, everyone that has been listening. I know there's a lot of information here to digest. And if you know of a business owner that is going through this process or considering, please share this. There's a wealth of information that Matt shared with us. And your business is one of the most important parts of your life. So we want to make sure that you're prepared for what is coming. So thank you again, and I'll see you next time.
Thank you.
Thank you so much for listening to the podcast. If you're going through a separation or divorce, please contact me through my website at everafterwealth.com. I would love to be a resource and partner as you navigate this season and prepare for your financial future. I'll see you in the next episode.